Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. If you'd asked an Australian investor 20 years ago where they should invest, the answer would probably have been pretty obvious. Australia, the ASX. I mean, there's not much other choice. Our biggest companies are household names. The banks dominate. You've got your BHPs and Rios that rode the China boom. And we've got franking credits as well, which always make Australian shares very tax effective. But today, I'd like to ask a question that might have sounded ridiculous back then, but does the Australian share market actually still matter for investors? Now, before anyone accuses me of being un-Australian, let me be clear. Australia absolutely needs a thriving stock market. Businesses need somewhere to raise capital, investors need somewhere to invest, and a healthy stock exchange is an important part of a healthy economy. But just because Australia needs a stock market doesn't automatically mean that Australian investors should continue to give it such a large allocation in their portfolios. Now, the reason this has come up is frankly because of the return numbers of the past decade. So let's take a bit of a look at those. So the single biggest determinant of whether an Australian investor achieved an outstanding return or merely an average one over the past decade has been how much exposure they've had to Australian shares versus international shares. If you invested entirely in Australian shares, including dividends, and I'm just using the ASX 200 here, right? Including dividends, your return would have been about 8% per year over the last decade. But if instead you owned US shares over that period, your return was roughly double at 16% per year in Australian dollar terms. Now, that's a huge differential. So $100,000 invested in Australian shares 10 years ago would be worth $220,000 today. But the same amount invested in US shares would be worth $440,000 today. In both cases, you would have invested in a broadly diversified index. In fact, the US is the S&P 500, whereas ours is the ASX 200. So arguably, you've got more diversification with the US index, certainly more diversification across industry. So it's not like you've taken a whole bunch more risk on the US side. Also, the difference isn't due to clever stock picking or market timing or any of that sort of stuff. In both cases, we're just talking about the market index. It is worth mentioning that a contributor to the superior returns of the US shares was the falling Australian dollar, but that wasn't the primary driver. It did help though. Now, one potential conclusion from this huge performance differential could be that the Australian market must represent, great value now, right? It hasn't risen anywhere near as much as the US market. So maybe the Australian market is where we should be throwing all our money if you follow that train of thought. So I had a look into that. Some of you might have seen some of this data in the Gaining Choice newsletter a couple of weeks ago. But for those who aren't already subscribed to that, I've got a little bit more detail here. So I guess the first thing to appreciate is that share prices are a function of earnings, right? If a business makes $1 million a year and the market says it's therefore worth 20 million, then it stands to reason that if their earnings doubled, so to 2 million, then the company value would also double. It'd now be worth 40 million, right? So the question then when considering whether a market's cheap or expensive is to learn what's happened on the earnings side, right? What are companies actually making in profits? Ideally, what we want is to see that a higher stock price is justified by higher earnings. Now, at the moment, the current forward PE ratio, the price to earnings ratio, it's a common way that businesses get, or valuation gets assessed. For the ASX 200, it's 18.8. So that means on average, the price of stocks is 18.8 times what they're expected to earn this year. Now, 3 years ago, the PE ratio for the ASX 200 was 16. 5 years ago, it was 16.5, and 10 years ago, it was 15. So again, right now, it's 18.8. So if anything, the Aussie market's a bit more expensive today than it has been over the past decade. So what about the US market? Well, for the S&P 500, the current PE ratio is 20.1. So it's a bit more expensive than the Aussie market. But 3 years ago, the PE ratio was 20. 5 years ago, it was 22. And 10 years ago, it was 18. So despite the US market significantly outperforming over the past decade, valuations are actually pretty consistent with long-term averages. Crucially, this tells you that the stock prices that we've witnessed are rational. They reflect higher company earnings. And as an interesting illustration of that, right, NVIDIA, which has been the biggest beneficiary of the AI revolution so far, and it's currently the world's biggest company. It holds the number one spot in the S&P 500. It's trading at a PE of 19.1. 19.1. Now, the market average is 20.1. So NVIDIA, that's rocketed, right? Its share price in the last 5 years is up 993%. So it's been an absolute rocket ship. It's gone from almost nowhere to be the biggest company in the world, right? Yet, when you value it on the basis of what it's earning, it's actually a little bit cheaper than the market average. It's far from overpriced. It doesn't appear to be. So, again, illustrating that share prices have gone up in the US, but that's been fully supported by earnings going up too. The companies are worth more because they're making more money. Look, 100 years ago, the US wasn't the centre of the investment universe, but today it absolutely is. The US now represents over 60% of the world's listed share market. And it's not because American investors are particularly optimistic. As you can see from a valuation perspective, they're not really stretching things. But it's because many of the world's most valuable businesses, they're in America. Your Apples, your Microsofts, NVIDIA, as I've mentioned, Amazon, Alphabet, Meta. And these companies aren't merely serving Americans, they're serving the world. So the US market has increasingly just become the global market. If you want exposure to artificial intelligence particularly, but also cloud computing, semiconductors, software, biotech, digital advertising, whatever, the overwhelming majority of those opportunities are in the US, right? They sit outside Australia. So look, what's missing from our ASX? We've got some fantastic companies. We've got world-class miners. Our banks are world-class too. We've got big insurance businesses, healthcare, infrastructure. But if the AI revolution proves to be as significant as previous technological revolutions, and that's kind of the way things seem to be shaping up. So comparisons are being made with the printing press, with railways, with electricity, automobiles, or the internet, it's just really transformational from an economic point of view, then as investors, we probably want to be standing in the middle of that, right? We want to be participating, not watching from the sidelines. And the Australian market simply just doesn't offer us much exposure to these emerging technologies. Our market reflects the Australian economy, which is largely mining, agriculture, perhaps residential property, although maybe that's coming off the boil a touch. Tourism, I guess, is another important economic contributor for Australia. The global market, and as I've touched on, the global market really means the US market. It reflects the global economy, so it's just much more diverse, right? Conveniently, investing internationally has never been easier. So 20 years ago, there was a good argument for having a strong home bias because international investing, it was expensive and it was complicated. But today, it's almost effortless. So low-cost ETFs allow Australian investors to own thousands of companies across dozens of countries with the click of a button or two. Even Australia's largest retail broker, CommSec, now actively facilitates investing directly in overseas shares. Their recent SpaceX float involvement highlights just how far we've come. So the biggest Australian brokerage platform helping Australians participate in a float in the United States. Never happened before. It's incredible. So the barriers to international investing have largely disappeared, which means we're no longer restricted by geography. Let's just zoom out a little bit in terms of Australia's position, and because I guess when we're talking about whether we want to continue to be biased towards Australian shares, it essentially means we're biased towards the Australian economy. So Australia has enjoyed an extraordinary run of prosperity. I've lost track now, but we haven't had a recession for it's 27, 28 years or something, which is just amazing, right? But there are reasons for concern. Productivity growth has slowed, right? That's in the press all over the place. I'm sure that's not news to you. Much of our economic strength remains concentrated in housing and resources. Meanwhile, for many of the world's fastest growing companies, they're creating intellectual property, right, rather than those kind of physical assets. Now, it doesn't mean that Australia's destined to decline. Far from it. Australia's a great place to live. Our super system is fantastic insofar as people's retirement is provided for and saved rather than some sort of debt that the government has to fund in the future. And our federal budget position is the envy of many nations, right? We don't have huge federal government debt. States may be a little bit different, but at the federal level, we've got it pretty well under control. But from an investment perspective, we have to ask whether our economy is likely to produce the world's biggest future winners. And history suggests, probably not. One of the fascinating things or differences between the US and many other countries, certainly Australia, is their willingness to embrace failure. So, businesses fail, right? It involves taking risk. But if you're prepared to accept that, then that's where the good companies can prosper, right? You need a willingness to have a go, and if some things don't work out, that's fine. Capital gets recycled, people move between companies if one business fails. You need those economic cycles. Successful ideas attract enormous amounts of investment. They have all their venture capital over in the US. Now, it does mean that you get a bit more volatility. So if you invest on the US market, you'll notice that it's a bit more of a roller coaster than the Australian market. But that's how you get innovation, and ultimately that's how you get growth. And as an investor, you're getting rewarded for accepting that higher level of volatility. Now, franking credits often comes up whenever we talk about Australian shares. Some people, I only want Australian shares because of the franking credits. And look, franking credits are valuable, right? It is relevant to recognise those. And so particularly for retirees, you might have a bit of a bias to Aussie shares, right? It does enhance your return. The benefits shouldn't be ignored. So certainly not proposing, as I say, particularly for retirees, that they would abandon ASX company holdings entirely. But to sort of suggest that because of franking credits you're going to have all your money or the majority of your money in Australian shares, I think is a false argument, right? Underlying what you want is investments that are going to grow. Just another train of thought to consider in terms of our allocation between locally listed shares versus international shares is that outside of our investment, we're already heavily invested in our domestic economy. So as Australians, we've already got enormous exposure to the economy. Our salary depends on the success of the economy. Our spending is impacted by Australia's inflation and exchange rates. And for homeowners, our personal balance sheet reflects the residential property market. When almost every aspect of our financial life depends on Australia continuing to prosper, there's actually a strong risk management argument for investing more of your portfolio overseas, right? Diversification. It's also worth noting that the ASX itself is changing. So a lot of Australia's biggest companies are increasingly looking beyond our shores with listings overseas. So BHP, Rio, CBA, CSL, ResMed, James Hardie, Amcor, Telstra, even something as uninternational as Woolworths. They've all got listings overseas now as well, so they're not just listed on the Australian stock market. Australia's biggest sort of IT growth company, Atlassian, they never listed on the ASX at all. And Australia's biggest private company, Canva, at some point they will list, and almost certainly they'll list in the US rather than locally. So, look, our most successful companies, they've concluded that accessing global capital markets offers some great advantages, which should tell you something, right? If our best businesses increasingly think globally, then perhaps as investors we should too. Back in 2012, the Singapore Stock Exchange proposed merging with the ASX. The deal was ultimately blocked by the Australian government on national interest grounds. At the time, many people thought that was an obvious decision. But 14 years later, the world looks a lot different. The ASX represents a smaller share of global investment opportunities than it once did. International investing's become dramatically easier, as I've already touched on, and global businesses increasingly dominate wealth creation. Most of the stock exchanges in Europe are now integrated into Euronext, and that merged with the New York Stock Exchange in 2007. The Nordic countries went a different way, but they merged theirs into an entity known as OMX, and that's actually now owned by the Nasdaq. So a lot of countries have merged stock exchanges. The ASX as a standalone entity, it looks increasingly isolated. Look, some final thoughts. The Australian share market will definitely have its day in the sun, right? Markets move in cycles, and there will be periods where Australian shares outperform US and more broadly international shares. Hopefully also the Australian economy improves its global competitiveness, and the value of our dollar lifts, which would eliminate some of the performance difference we've seen between Australian and US shares. But I think the bigger trend is difficult to ignore. The world's investment opportunities are becoming more global. And fortunately, we live in an age where we can participate in that. And so I think we should, as investors, it's really important that we're just conscious that global investing is what we need and not to be excessively biased towards our domestic market. All right, look, before we wrap up, if you found this episode helpful, share it with a friend who you think might benefit too. Of course, make sure you subscribe on Spotify or Apple or whatever so that you get the episodes all the time. If you've got a question that you'd like me to answer, I respond to reader questions every Sunday in the Age, Sydney Morning Herald, etc. in the money section, the Ask an Expert column, and you can find some details on that in the show notes. And just finally, if you want to stay across the biggest finance and market headlines each week, you can subscribe to our Gaining Choice newsletter. It comes out every Friday. And again, if you go into the show notes, you'll see how you can add yourself to the list for that. All right, well, thanks for listening, and bye for now.